There is so much happening now. It is the great leveler. But if you don't get on the right side of change, you're going to be left in a disrupted world order.
Hey guys, welcome back to Library of Wealth. Today we have ARK Invest CEO Cathie Wood giving us a market breakdown and where the economy is headed for the end of 2022. Although not everyone agrees that this is the wisest course of action for the US Central Bank, investors are more confident that we will see a third consecutive 75 basis point interest rate increase, which according to Wood will have catastrophic implications on the economy. If the Federal Reserve keeps hammering the economy with interest rate increases, in her opinion, we are guaranteed to see deflation. Wood believes another signal that more economic hardship for Americans is coming is the Federal Reserve's use of lagging indicators. She says they're making a huge mistake with their monetary policy, and unless a pivot happens, deflation is a certainty. Let's check out this interview with Cathie Wood as she gives her market predictions for the next few months. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
We're probably going to see some deterioration in employment as well. So the Fed will pivot. We just saw a liquidity crisis in the UK. Pension funds, because the increase in interest rates has been so rapid, led by the Fed, pension funds were offsides in terms of their derivatives, and there was a run, margin calls. This has happened just recently, and that is a sign that there's a liquidity crisis brewing out there because interest rates have moved up too fast. We think the Fed is now making a mistake. We have a contrarian point of view here. We think the bigger risk in the next 1 to 3 years is deflation, not inflation. And it's both good and bad deflation. We're already seeing cyclical deflation in the pipeline. We've got commodity prices down 30, 40, even oil, 30, 40, 50, 60, 80%. And it's because China's in recession, Europe's effectively in recession, and we think the US is in recession. So you've got deflation coming in the pipeline, and we have a massive inventory buildup that is actually shocking. Nike, for its recent quarter, reported that its sales were up 3% and its inventories were up 44%. In North America, its inventories were up 68%, and the inventory in transit is up 85%. This is going to overwhelm retailers, and the only way they'll clear their shelves is to discount aggressively. We're already hearing Walmart, Target, and others talking about discounting. We think cyclically we've got deflation, and then secularly, meaning longer term, we believe we have deflation because of innovation. Now that's good deflation. You cut the price of something, units will increase. So we think we're going to see some booms in categories of innovation. But at the same time, if we're right on that, there are a lot of products in the old world that are going to be obsolete, and they'll have to cut prices. That's bad deflation. So we see deflation, frankly, all over the place. And the Fed right now is looking at two lagging indicators. It's looking at CPI inflation, and I just told you what's in the pipeline, and it's looking at employment.
Wood believes the Fed rates will decrease by the start of next year because the economy is showing signs of extreme weakness. The employment charts have been down for the last 4 months, and we're seeing many layoffs from companies everywhere. Cathie says while it's good and bad, and while it's a bigger risk than inflation, she's already seeing cyclical deflation in the pipeline.
One of the reasons I've been drawn to innovation is actually a great leveler. We have never seen the amount of innovation that is taking place now. There's an absolute explosion of it. The seeds for all of it were planted in the 20 years that ended in the tech and telecom bubble, but the technologies weren't ready for what we're talking about now. AI breakthroughs really didn't start happening until 2012, well after 2000. And even cloud computing didn't happen until AWS, Amazon Web Services, in 2006. We're seeing 5 major innovation platforms: genomic sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. They involve 14 different technologies, and we believe they're moving into exponential growth trajectory. So what we say to our companies and to our clients is get on the right side of change. There is so much happening now. It is the great leveler. But if you don't get on the right side of change, you're going to be left in a disrupted world order. Sure, there are risks in innovation, but there are risks in not being there. And we think those risks are growing by the day. Consumers and businesses, if they're afraid, they're willing to change the way they behave. There's a lot of inertia in human behavior, and they're willing to change. In terms of an unmet need, that's why I founded ARC. I saw the traditional asset management world focused on public equities going passive. And at the same time, we saw this explosion of innovation. You know, the seeds were planted a long time ago. The technologies are ready now. The costs are low enough. It's just so ironic that because of what happened in the tech and telecom bust, people won't go near a lot of innovation these days. That's a good thing. That's a good thing from a portfolio manager's point of view. I know we are not in a hype phase, but I do feel the unmet need that we are filling is innovation as a special asset category, because benchmarks and passive are all based on backward-looking indicators. The stocks in those portfolios are there because of their past success. If we're right, and these 5 major platforms, which involve 14 different technologies, are going to disturb, if not destroy, the traditional world order, if we are right, then it is imperative that investors have, I would say, a very good allocation to innovation, however one wants to define it, to innovation, so that they're looking at the future and, riding the coattails of these new technologies and these exponential growth trajectories that we believe are going to be transformative for the world. The return profile, again, this is similar to our public funds, but the return expectation is higher. We have a 5-year investment time horizon generally. I shouldn't say generally, always 5 years plus. The return expectation is somewhere in the 20 to 25% per year range. Now, for our ETFs in the public equity markets, these are more mature companies, that number is 15%. So again, this is just filling out, a space that is where we should rightly be, because we are so exclusively focused on disruptive innovation. It's really interesting when I hear Wall Street talking about innovation, they're really coming at it from a negative angle. They're talking about the reasons it won't happen. And one of the reasons is that Wall Street and a lot of investing has become very benchmark sensitive. It's gone passive in a way. And so there's less and less research being done. There's no reason for many analysts to follow stocks because they're not in their benchmarks. Those are the innovation stocks that we follow. And I believe that's why we have the best research. We're very focused on innovation and how likely or not will scale during the next 5 to 10 years.
With CPI inflation, as well as employment being the 2 biggest indicators the Fed is looking at, Wood believes they've raised rates too fast and thinks they're making a big mistake. ARK Invest has seen a massive liquidity crisis in the UK with their pension funds, which will cause them to raise interest rates as well. If Wood's interpretation of deflation as cyclical and secular is correct, the coming deflation will actually be a good environment for the financial market's growth. What do you guys think about Cathie Wood's economic outlook for the next few months, and how deflation might be a bigger risk to the market? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.